Right, we got people coming in now. So we'll go ahead and get started here. Hello, everyone. My name is Caleb Pearson. I'm one of the financial advisors and owners here at Compass Financial. Thank you so much for joining us today. This is a topic that's been coming up more and more, it seems like, over the last few years. And so something that with our monthly educational events, we wanted to be sure to, excuse me. We want to be sure to bring that to you and try to educate you on this topic of ESG and sustainable investing. So to do that, we've brought in an expert. We have Mary Green with us today. Mary works with Federated Hermes, which is a mutual fund company of an investment firm, and they recently started with them acquiring Hermes Investments. They've started to dive more into this ESG world, and Mary here is an expert on that, and so we're really excited to have her here today. She has more than 25 years of investment experience in this industry, and most recently, since 2019, joining Federated, she's taken on some of this educational role and portfolio management work in this area. So Mary, why don't you go ahead and get us started? And before I do that, actually, there will be a question and answer at the end. So if you have questions throughout the presentation, you can just reply to the email I sent this morning, caleb.pearson@compassiowa.com. I'll get your answers or your questions from there. And then you can also text your questions to our office line here at 515-327-1020. So with that, Mary, go right ahead.
Great. Thanks so much, Caleb. I'm so happy to be here today representing Federated Hermes. We believe that responsible investing is the best way to create long-term value, whether it's bonds, stocks, every asset class, there's a place. Now, ESG has really been a hot topic in the news. It seems like it's part of the culture wars even. So I'm just here today to bring some clarity to the topic. This may be your first time hearing about ESG, or maybe you consider yourself a responsible investor too, and you really do like ESG funds. I'm going to bust some myths and just talk about, give you some straight talk about ESG today, and hopefully we'll all come out a little bit smarter on the topic. So let us dive in. So here you see the tremendous momentum behind responsible investing in ESG. On the left are the number of signatories to the UN's Principles of Responsible Investment. My firm, Hermes in London, was an author and founding signatory of the UN PRI. So we have been shaping the conversation around responsible investing from the very earliest days. Today, there are thousands of asset managers and asset owners that have made the commitment to incorporate ESG into their investment program. And you can see just that hockey stick of fund flows to ESG. So it's more than 10 times the amount of AUM in responsible products than there were 4 years ago. So there's just a lot of interest. Every year, we talk to professional investors like Caleb to ask them about ESG. And over 95% of them say that their clients are asking about it and hungry to learn about it. And that doesn't surprise us, because the global pandemic has really shown a spotlight on the social as well as the environmental and governance topics. So almost 75% of investors are seeing increased importance of issues like diversity, equity, and inclusion, availability of healthcare to the public, that type of thing. Also, data privacy and security is a ESG issue. How companies like Facebook are using your data. Supply chain resiliency, very important within the context of the global pandemic. And more investors are seeing the financial benefit of ESG. Here's a quote from a large US public pension plan. They've done a lot of research on this, and they think there's a demonstrated enhanced return by considering ESG factors. And we'll put a little more meat on those bones in a minute. So what's driving the interest and the adoption? Well, of course, there's always a push and a pull, a carrot and a stick. So investors, society, the public are changing. Younger people especially are interested in responsibility in their jobs. They want jobs with purpose. They want to consume responsibly. There's a sharing economy. And so there's a real shift in consumer preferences happening. And at the same time, the government is requiring more disclosure around non-financial issues by public companies. Investors are always looking to find sources of alpha, seeking mispricings, as well as risk mitigation, while corporations are seeking lower cost of capital, especially in a rising interest rate environment. So everybody's adapting to change, and ESG considerations really factor in because they are a source of information, an additional source of information on companies that help investors to find those mispricings and helping investors to mitigate risk. So here's where I get to bust a myth. What is ESG? I'm here to tell you it's not an investment strategy. ESG is data. It's material, non-financial data that can have long-term financial impacts on a company, and therefore a prudent investor should really consider them in their investment program. So E is environmental. These are considerations that affect the natural world. Everything from climate change to deforestation, product life cycle management, pollution, waste management, that type of thing. S is social. Everything that hits humans, affects humans like you and like me. Our lives have really been changed in the last couple of years as governments have pulled back on economic activity in order to safeguard our health and our lives. Some people say that the global pandemic and these government and corporate decisions are the biggest ESG decision of our lifetimes. So social is everything that touches humans. It could be anything from human rights in the supply chain to working conditions for people like you and like me, employee relations, those diversity and inclusion issues as well, public health, public safety. Social, everything that touches humans. And governance is something that we as investors have been very comfortable considering in the context of our investment programs for a long time, how a company governs itself and safeguards against risks like anti-bribery and corruption, issues of executive pay, risk management, tax strategy, board structure, share class structure, corporate reporting. So ES and G. Material, non-financial factors that can have long-term operational and financial impacts on a company, therefore should be considered in the investment decision. I like to think of this as an expanded set of data that we as investors can use in order to get a 360-degree view of risk. So now that you understand more about what ESG is, does it add value in the investment equation? And what we have here are results of a meta study or studies of academic studies that are proving the financial value of ESG. Within this particular meta study, 90% of the reviewed studies show that sound ESG standards actually lower corporate cost of capital. Think about it this way: if a company is perceived and demonstrating that it's managing risks better, it will have a higher debt rating and lower cost of debt, for example. Operational performance, 88% show that solid ESG practices result in better operational performance. Now let's go to the S column for this one and think about employee relations. If a company has poor employee practices and employee relations, it will probably have higher turnover of staff, and it costs much more to continually rehire and retrain staff than it does to have them go through their their career paths. So that's a simplified example, but I think illustrative. And then 80% of these reviewed studies show that stock price performance is positively influenced by good corporate responsibility practices. And this is but one meta study. There's a more recent one out of NYU that has similar findings. They find that ESG in the investment equation works better over long periods of time. And I would have to agree with that. So quantifying ESG, we look at this at our firm and we show what you're seeing here are the top decile versus the bottom decile of quantitative ESG scores by Federated Hermes. And you're finding that companies with good and improving governance, that's the dark blue line on the right, outperform companies with bad and deteriorating governance by up to 24 basis points per month. And this is over long periods of time. This is over 11 and a half years. Social can add good and improving social behaviors can add up to 19 basis points per month. And there's a positive impact from good and improving environmental practices. It's just not as statistically significant. And the same is true within fixed income. So we have shown here at Federated Hermes that credit markets are likely to reward companies that make the transition from ESG laggards to leaders with tighter CDS spreads. So what that means is companies with poor ESG practices will have will pay higher interest rates. Also, this is, I think, really interesting. I think a lot of the criticism in the news is that, well, ESG strategies as a whole are underperforming this year. That's because there are crowded trades within ESG. So a lot of ESG funds will simply not own fossil fuel companies, for example. And you can see where that would impact performance. That is screening. That's but one type of ESG strategy, and it's including or excluding industries based on specific values. So there's a range of outcomes that you're looking for when you're investing. They range from pure financial outperformance to more mission-driven outcomes. And it's a spectrum of outcomes because one does not preclude the other. You can absolutely have a very good performing mission-driven strategy. And we show that with the empirical evidence on the previous page. But I think it's illustrative and helpful to look at the range of outcomes you're looking for and the types of strategies that align with those outcomes. So pure financial outcomes benefit from incorporating ESG factors into the investment process in order to mitigate risk. That is called ESG integration, and that is a widely used used strategy. US SIF, the Sustainable Investment Forum, says that ESG integration is the most popular form of ESG investing. These are not products that you're going to see a label of ESG on, but we're using this expanded set of data in order to support better long-term risk-adjusted returns. That's what ESG integration is. And as you move right towards more mission-driven outcomes, you might want to be reflecting your values in a portfolio. Say you don't want tobacco in your portfolio. So you'll exclude tobacco, or these fossil fuel companies, you will exclude it. These are screening strategies in order to reflect values. This is the very first form of ESG investing. It was called socially responsible investing back in the day, in the late 60s, early 70s. And it's one type. Thematic, it's for investors who want to access change, big mega trends that come out of the responsible, sustainable investing world. So this is to align and focus on ESG megatrends and sustainability themes, anything from gender equity to renewable energy. And then impact. This is if you want to make a difference through your investment program. So for investors who are seeking to generate measurable environmental and social benefits. So under this, these are 3 sustainable strategies. That's because ESG is in the driver's seat. You're seeking environmental and social outcomes through the investments. ESG plays a supporting role for within ESG integration. So these are some types of strategies that might align with what you're looking to achieve in your investment program. And every strategy benefits from ESG engagement, and that's active dialogue from investors with the investee companies in order to really understand risk and advocate for positive change. Let's look because ESG integration is the most popular strategy, let's look at differing levels of commitment. It's not a one-size-fits-all proposition, and you'll find different investment managers incorporating ESG differently. The first level of ESG integration would be the ratings. Some managers simply outsource their ESG analysis to the publicly available ratings agencies and data providers. So what this means is they will have a positive screening strategy where they'll simply buy companies that achieve a positive rating from Sustainalytics or MSCI. So that's ESG 1.0. What it really boils down to is outsourcing your data analytics to the ratings providers versus looking at it in-house. And there's some issues with this. The ratings are based on corporate disclosures, what companies are saying about themselves in their annual corporate sustainability reports. These are put out once a year. They're static. They tend to be backward looking, and this is not built for alpha generation. So that's just something to keep in mind if a company says, or if an asset manager says, yes, I'm really fishing in the top quartile of the Sustainalytics ratings. Going down to ESG 2.0, that's a materiality assessment. So ESG is not itself one size fits all. What's material to a healthcare company is really different than what's material to an energy company. So you want to make sure that when you're analyzing, if you're doing your research in-house and you're analyzing the impacts of potential ESG risks, you're analyzing the right types of risks for your industry and the company. So that's a materiality assessment. And then ESG 3.0 is engagement. And that is what I referred to on the last slide as talking to companies to really understand what's going on, how they're viewing ESG risks and opportunities, and how they are taking advantage of them and mitigating them. So that is ESG 3.0. So I'm just trying to make you better educated consumers of what is put out there as ESG strategies. You can already see why so many sustainable strategies were overweight big cap tech as the tech bubble burst this year. That was a real headwind because tech tends to get better ESG ratings because there aren't human rights issues typically. These are a bunch of Silicon Valley companies that treat their employees well. There's not a lot of hard assets and big supply chain issues where there could be big ESG risks. Also, it was a big crowded trade to be underweight energy. And guess what? Energy has just been on fire this year as a result of the war in the Ukraine. So responsible investing is active investing. There's two sides of the responsible investing equation: what's owned and how it's owned. And on the left side, you can see all the different approaches to incorporating ESG into your investment program. You can have that negative screening. You can have positive or best in class screening, again, based on the data. You've got ESG integration to support better long-term risk-adjusted returns, the thematic and impact investing. But when an asset manager signs that the principles of responsible investment, they commit to not only incorporating ESG into the investment equation, they commit to to incorporating ESG into their ownership policies and practices. So together, the aim is to generate sustainable wealth for you, incorporating both investment returns as well as their social and environmental impacts. And so just as there's a wide range of using ESG in investments, there's a wide range of approaches to being this active owner, this responsible owner. So here's the stewardship model. Some investors will say, yes, I'm an active owner because I vote proxies. That's but one piece of it. It's also engagement, it's advising, it's talking with companies. And we do this pretty deeply at our firm, at Federated Hermes. You can get a lot of good information. You can use your ownership rights in order to encourage companies to act more responsibly. We only engage if there's a mismatch between corporate behavior and long-term share owner value creation. So we will engage to close that gap. Because we've been doing this for close to 19 years, the data from our engagements is used by academics to prove the value of active ownership. And what you see here, the blue line, these are companies that are successfully engaged 18 months post-engagement. So they are moving along a milestone system. They are agreeing that our ideas are worthwhile to pursue. They're closing that gap between their behavior and long-term value creation. And guess what? They outperform in the 18 months post-engagement by 7% over the expected return of the stock. All engaged companies put up a 2.3% abnormal return over expected return, and unsuccessfully engaged companies, companies that aren't making progress in engagement, they perform about as expected. So at least we're not destroying value. This is what an engagement team looks like. We have a global team, over 60 ESG subject matter experts representing 17 nationalities and 15 languages, because it's important when you're talking to senior management and boards to talk in the language that they speak. We've got a wide array of industry experience, from climate change experts to former heads of social responsibility at companies. And we've been doing this for close to 19 years. We have 1.6 trillion in assets under advisement because we're engaging not only on behalf of Federated Hermes, but other asset owners that want to incorporate responsible investing. This is what it looks like. ESG risks and opportunities. Every big value destroying corporate controversy that I can think of does always tie back to environmental, social, or governance. People often say Enron, that was a failure in governance. The BP oil spill, in the Macondo field, environmental. That's why it's really important to make sure that you're managing these risks well. So human rights in the supply chain, having child labor, mistreating your supply chain, that can have real reputational, financial, negative impacts on a company. So we have different milestones in an engagement. Milestone 1 is when we raise a concern to a company. You've got substandard migrant working conditions. And that is milestone 1. Milestone 2, this is where it really gets constructive, is when the company acknowledges the need to address these migrant worker conditions. And that could take a year between intro and the company acknowledging. Then milestone 3 is as the company commits to credible change. And in this case, they're committing to establish a labor standards task force and really dig into this issue and understand it. And then milestone 4 is as the company implements change. And we are happy to work alongside the company to help them in their discovery process, as well as how they address the issue. So Labor Standards Task Force improves conditions for migrant workers. So I'm going to tie it all together for you because we're coming up against our half hour. So ESG as well as engagement integration. We start at Federated Hermes with all of the publicly available data. We have 10 sources of it. That's Sustainalytics and the MSCI that I mentioned, but it goes even further. So we take all of the good publicly available data, and then we have proprietary data analytics in order to get the most value and make it decision useful for us as investors. So we do these quantitative ESG scores, starting with the public data, then informing it with insights from our active engagement. And that's how we come up with our proprietary quantitative ESG scores. We do in-house ESG assessments. This is our materiality assessment to make sure that we are understanding the most material ESG risks and opportunities. Think of materiality again as going back to non-financial factors that can have long-term financial impacts. We want to make sure that we are understanding the factors that will that could have the biggest impact over the long term. And so always we're going to insights from our active engagements, those insights from our ESG subject matter experts at every step of the way, and then security selection. So we're incorporating insights from our engagement division along with the materiality assessment, as well as the scores that we've given these companies, and we're making sure that that the stock or bond price is accounting for it. If they're not, if there's some extra value that the market's not pricing in, that will help us in our investment decision. So I hope that you are feeling a little more comfortable, a little smarter about ESG today, and what to look for and what to consider when you're making your investment decision yourself. Think about that range of outcomes that we're looking for. Do you want to reflect your values in your investment, within your investments? Are you looking to make a change in the world? Or do you simply want better risk-adjusted returns from a more complete and full set of data and considerations? Look for a company's commitment, a firm-wide commitment. ESG, not just as a one page on a screen of a asset manager's website, but a culture of responsibility. You want dedicated ESG experts, as well as independent oversight of ESG integration. We have a responsible investing office that does oversee our ESG data, proprietary analytics, as well as the engagement. Proprietary analytics, look for analytics beyond just choosing stocks based on their publicly available data. That's the outsourced rating providers. You want to also make sure that there's a materiality assessment going on. And then expert active ownership, combining active fundamental analysis as well as ESG engagement, actually for us creates unique insights for an information advantage. I think of it as stewardship, not just scores and screens. So that's what we offer at Federated Hermes. So I'm going to stop it there. We're up against our half hour and see if there are any questions that have come in, Caleb.
Yeah, thanks, Mary. That was all great information. So one question that we get quite a bit is, is there any sort of governing body or regulator who is overlooking this area of investing, not only on the fund level or the investment firm level, but on the corporate level to make sure that when ratings are given or, as fund managers, as they pick and choose investments, that they are actually uh, picking corporations that are ESG.
Mhm. Well, that's a great question. And remember, it goes back to, again, the spectrum of outcomes and what the objective of the fund is. Not every fund that incorporates ESG information is a sustainable fund as defined by Morningstar. So I think what you're talking about are those sustainable funds that have ESG as an objective. So it's driving investment decision making versus an input into the investment decision making. So up to now, there has not been a governing body, but it is a hot topic, and it's looking to become more regulated. And as a market participant, I welcome that, because the data is often not comparable. It's not available for the full array of companies that we might be interested in investing in. The SEC just recently put out some rules on incorporating climate information and how companies are viewing climate risks and accounting for climate risks within their reporting and disclosures. And so it's coming. It isn't there yet, but it's coming. Also, the SEC has put out a proposed revision for its names rule to make sure that what is under the hood in a sustainable investment that companies are saying what they do clearly and then doing what they say. So that the SEC is getting more and more involved in helping to regulate this sustainable investing, for sure.
Okay, great. Again, anyone, if you have any questions, you can email them to me. I have another one here, but my email address is caleb.pearson@compassiowa.com. The other question that I've gotten in the past is, do you have any idea or general idea of how many or what percentage of companies, say in the S&P 500 or Russell 2000, actually get beneficial ESG ratings? Obviously, throw all of the most of the energy companies out, or some of the tobacco and all of those obvious ones. But do you have a general idea of?
Yeah, that's a very complicated question. Let's talk about the S&P 500. And it's also where materiality comes in. There are ratings for all S&P 500 companies. You can look within sectors to choose, the best actors within a poor sector, for example. So there are more favorable ratings within the energy sector, more favorable to less favorable. So you might have an ESG Improvers strategy, and there's a lot of research on this today that companies that are improving their ESG behaviors can unlock value and can outperform even companies that achieve good scores. So ESG Improvers is a really interesting type of strategy too. So again, it's just funny because it's not how we think about at Federated Hermes. It's not how we think. We don't really consider the publicly available scores from an MSCI or Sustainalytics on their own. It's just an input into our own scoring system. And so again, it's stewardship, knowing the companies on a firsthand basis through long-term dialogues with senior management and boards to really understanding stewardship, not scores and not screens. So I'm sorry I can't be more helpful. I just we don't think about the data
Right.
on its own. It's part of the mosaic.
Yeah, I get that. And really my goal today, thank you, Mary, for that, it was just to kind of get the information out there, get people thinking about, okay, it's more than just a rating that you see, kind of like your point is, if it's something you're really interested in and something you're passionate about and something you want to do, make sure you dig deeper than just picking out one ESG fund and going with that, because you don't know if all they're doing is using that public information or if they're being proactive, not only in picking the companies that they're choosing within the fund, but also going above and beyond and, trying to be proactive with those companies to improve their processes and everything. So I really appreciate that.
Well said. Thank you.
Yeah. So I have one more question, looks like. In what way are these these investments protected from government overreach? Any thoughts on that?
Overreach.
I'm not sure how that.
Yeah, I think that what they might be getting at is the emerging regulatory oversight of
That's kind of how I read
ESG
it.
investments. And the government, I was just with an SEC commissioner yesterday, and what she was saying is that they are looking to regulate these investments and understand and seeking clarity with these investments, because it's what investors want.
Mhm.
Investors are interested in it. They want to make sure that, and I actually applaud this, they want to make sure that an ESG labeled strategy isn't simply, like you said, simply positive screening for the best companies without really understanding the investments. They want to make sure that that we're getting, as investors, decision useful information, the information that we need in order to properly understand an investment. And that's where the enhanced disclosures and additional disclosures are coming in. And I think that that's a useful thing. More data, any source of data, comparable data is going to be most useful for us as investors.
Mhm.
And so, and also, it's really interesting. These are not fully formed regulations yet, and they're really seeking the input from the industry, from us as investors, to understand what would be most helpful for us. And so it really behooves us to let them know, what we want as well.
Great.
So I don't see it as overreaching. It's really creating more transparency
Mhm.
in the markets and more decision useful data.
Okay. Another question that came in is there a website or a platform that we can use that is free to use that will provide ESG information for different holdings or funds?
So I think that the Morningstar website is a good place to start. They have given their sustainability rating or label to about 550 mutual funds. That's a good place to start. If you'd like to really understand what we mean by materiality, you can go on to SASB, SASB, SASB.org, O-R-G, SASB.org, to see what ESG, environmental, social, and governance factors are most material to an industry that you're participating in or interested in, you can see what is material. And that's interesting. And yeah, there's Just Capital and As You Sow are also interesting websites to go on to if you want to explore sustainability issues as well.
Okay. Another one that came in here, seems like ethical behavior of corporate leadership fits in governance. How might that be evaluated or determined when you're looking at a corporation?
Yeah, that's a very good question. And it's part of it's a material consideration for sure. It's part of our quantitative governance score, ethical behavior. Obviously, this is something that we want to avoid in our investments. I would just have to say that I agree. And, how are some good ways that we figure that out? It's best evaluating corporate governance and evaluating boards and senior managements is best done face-to-face. And I think that's where having a very strong stewardship and engagement capability really is another benefit. You're right, whoever said that. It's definitely weighs into our quantitative governance scoring.
Yeah, it seems like so much with this whole topic is subjective, and it kind of comes down to knowing and trying to understand as best you can, and nothing is going to be perfect, just like anything in this world. But at the end of the day, having experts like yourself and the managers that you guys have over there at Federated who are in it all day, every day, and they know what is good and what looks good and what might not look so good and everything. So that's why we appreciate you guys and the work that you do there.
Thank you so much. And I'd like to say, I didn't say it during my presentation, but at Federated Hermes, we are 100% ESG integrated. That means that we're using ESG as an input into our investment process with these proprietary analytics, with these QESG scores informed by insights from our experts within our Stewardship and Engagement division, for sure, 100% ESG integrated. However, not all of our products are sustainable products. So ESG labeled products where we have a few offerings, but really we're using it to enhance returns, enhance long-term value within all of money markets, fixed income, equity, private markets. We're 100% ESG integrated.
Great. Well, that's it for questions. Do you have any other comments before I wrap things up here, Mary?
I just want to thank you for the opportunity today. As you can tell, it's pretty nuanced. And I just think that as you read the headlines and read everything that's emerging in the papers, you're going to feel a little bit more engaged with it now that you understand more. And now you can understand there's a lot of criticism in the papers today because of those crowded ESG trades that were a result of the screening. Everyone was overweight tech, underweight energy. And it's helpful to be more thoughtful about it and to seek ESG strategies that really fit with your objectives as an investor too.
Mm-hmm. I appreciate you saying that. And that was, again, also my goal is just to educate kind of a little bit more on the topic today. And if it is something that you're interested in incorporating more in your investments here at Compass, I already got one email from a listener that said, how can we incorporate this more into my portfolio? So that's a good thing. So we have access to Federated Hermes funds as well as other fund companies that have similar strategies. And so if you are a client and you do have questions or you want to discuss it, please bring it up with your financial advisor the next time you're in. So with that being said, I want to thank you again, Mary, for making this happen. And Casey, who's our wholesaler, I appreciate you setting this up. If you guys have any questions, let me know. I'll be sending out an email with a link to this presentation. So If you want to share it with anybody who might be interested, or if you want to watch it again, feel free to do so. Thank you.
Thanks, Caleb.
Yep. Bye.
Bye-bye. Thank you.